George Soros, a name synonymous with bold, high-risk financial strategies and massive successes, is one of the most well-known investors in the world. His reputation was cemented in 1992 when he famously broke the Bank of England by shorting the British pound and profiting billions in a single day. But Soros's success is not just the result of one famous trade, it's the culmination of a lifetime of understanding financial markets through a unique lens. Soros is the founder of Soros Fund Management and Open Society Foundations, two organizations that have had far-reaching impacts on both the financial world and global politics. Soros's approach to investing is often classified as global macro, a strategy that involves making investments based on the economic and political trends of entire countries or regions. Unlike traditional stock-picking strategies, global macro investors focus on broader market trends, including shifts in currency values, interest rates, geopolitical events, and economic policies. Soros's approach is often described as a combination of reflexivity theory and a philosophy of risk management. Reflexivity, a term Soros coined, refers to the feedback loops that exist between market participants' perceptions and reality. In other words, markets are not always rational, and the beliefs and actions of investors can influence the underlying fundamentals of markets themselves. Soros's ability to capitalize on these market inefficiencies has been a key factor in his success. However, what truly sets Soros apart from many other investors is his risk management philosophy. While many investors focus solely on maximizing returns, Soros is equally concerned with minimizing losses. His strategy centers around making large, high-conviction bets on macroeconomic trends but balancing these with careful risk management strategies to prevent catastrophic losses. In this first part, we will dive into the foundations of George Soros's investing philosophy, exploring his global macro approach and understanding how his reflexivity theory has shaped his strategies over time. By the end of this section, you'll have a clear understanding of what sets Soros apart from other legendary investors and how his approach goes beyond mere speculation into a deep understanding of financial markets and human behavior. Reflexivity and the foundation of Soros's strategy. One of the most critical concepts that drives Soros's investment approach is his reflexivity theory. Unlike traditional economic models, which often assume markets are rational and self-correcting, reflexivity suggests that markets are influenced by the participants' beliefs, which in turn can alter the fundamentals of an economy. In other words, financial markets are not merely a reflection of economic reality but are part of a dynamic feedback loop where perception can influence reality. Soros first introduced this concept in the 1980s, and it became the cornerstone of his global macro strategy. According to Soros, investors' perceptions of markets can become self-reinforcing, leading to boom and bust cycles. For instance, when investors become overly optimistic about a particular asset or market, their collective belief can push prices higher, making the initial perceptions appear true. But when reality fails to match expectations, the cycle can reverse, leading to a crash or correction. Reflexivity explains why financial markets can become disconnected from underlying economic fundamentals. Traditional financial theories often assume that prices are driven by rational actors making decisions based on available information. However, Soros argues that in reality, prices are influenced by human behavior and the collective psychology of investors. This leads to market bubbles, where asset prices can become inflated based on perception rather than actual economic value. For Soros, understanding this theory is crucial for capitalizing on market inefficiencies. His success is based on spotting these inefficiencies, where the market's perception of reality diverges from actual economic conditions, and making large bets on the outcome when he believes the market is mispricing an asset. The 1992 British pound short is perhaps the most famous example of this. Soros believed that the British government would be unable to maintain the pound's value within the European exchange rate mechanism due to the economic pressures of the time. By betting against the pound, Soros and his fund made $1 billion when the currency devalued. However, reflexivity isn't just about identifying market mispricings. Soros's theory also includes understanding the psychological dynamics that influence investors. It's about recognizing the emotional and irrational forces at play, such as fear, greed, and optimism, which often lead markets to overshoot or undershoot fundamental values. Soros has long maintained that by understanding these psychological factors, investors can better anticipate market movements and position themselves accordingly. Through the lens of reflexivity, Soros sees the world of finance as one where investor behavior can influence economic outcomes, creating opportunities for astute investors to exploit. His ability to navigate these psychological factors and market misalignments has allowed him to generate extraordinary returns throughout his career. In this section, we'll explore how reflexivity guides Soros's decisions and the major markets he's targeted over the years, including currencies, commodities, and equities. Soros's global macro strategy in action. George Soros is often described as a global macro investor, a style of investing that involves making decisions based on the economic trends of entire nations or regions. While traditional stock picking involves buying individual companies, global macro investors like Soros look at the bigger picture, including macroeconomic indicators, political events, and global financial trends. These can include interest rates, inflation, geopolitical events, and currency fluctuations, all of which can have a significant impact on markets. Soros's global macro strategy is based on identifying major trends and shifts in the global economy and capitalizing on them. Unlike value or growth investors who focus on individual companies, global macro investors make large, directional bets on entire sectors or countries. Soros's bets often include positions in currencies, commodities, bonds, and equities, depending on the macroeconomic outlook. One of Soros's most successful trades was his bet against the British pound in 1992, known as Black Wednesday. Soros correctly predicted that the British government would be forced to devalue the pound due to economic pressures, including inflation and high interest rates. He shorted the pound, and when the British government devalued the currency, Soros's fund made an extraordinary profit. This trade cemented his reputation as one of the most successful global macro investors in history. Soros's global macro strategy also involves geopolitical analysis. For instance, he was an early investor in Russia in the 1990s when the country was transitioning from a communist system to a market economy. While many investors were wary of the instability in Russia, Soros saw an opportunity to profit from the country's transition and the potential for significant growth. Similarly, Soros has made significant investments in China and other emerging markets, where he saw long-term potential for economic growth. In the context of global macro investing, Soros's approach is not just about making speculative bets but about thoroughly understanding the political and economic environment in which he's operating. He looks for market inefficiencies caused by political instability, market dislocation, or economic mismanagement, and then positions his portfolio to capitalize on those inefficiencies. We'll dive deeper into specific instances of Soros's global macro strategy in this section, including his involvement in currency speculation, his bets on emerging markets, and his investments in commodities. We will also explore how Soros has managed risk in these highly volatile markets, often taking large, highly leveraged positions that have both the potential for substantial gains and the risk of significant losses. Risk management and leveraging market opportunities. Risk management is at the heart of George Soros's investing philosophy. While many investors focus solely on maximizing returns, Soros understands that managing risk is just as important, if not more so. His success as an investor has been built on a deep understanding of risk, especially the risk of losing money. In fact, Soros once famously said, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." One of Soros's key risk management tools is the use of leverage. Global macro strategies often require large positions in various markets, which means leveraging investments to amplify potential returns. However, leveraging also increases risk, and Soros is known for carefully managing this risk through diversification and using stop-loss orders to limit potential losses. In addition to using leverage, Soros manages risk by maintaining a flexible approach to investing. While some investors make fixed, long-term investments, Soros is always ready to adjust his positions based on new information or changing market conditions. He doesn't hesitate to cut losses when a trade goes against him, but he also knows when to ride a winning position for maximum returns. A key to Soros's risk management strategy is his ability to stay emotionally detached from his positions. While many investors become attached to a particular trade or asset, Soros treats his investments like scientific experiments, making decisions based on data and analysis rather than emotion. If a trade is losing money, he's quick to exit, but if a position is gaining, he's disciplined enough to ride it until he believes the opportunity has been fully realized. In this section, we'll explore how Soros's risk management principles have played out in his most famous trades, as well as how he uses leverage and diversification to manage the risks inherent in global macro investing. Through careful risk management, Soros has been able to make enormous profits while keeping his downside risk in check. The philosophy of Soros's financial and political influence. George Soros's influence extends beyond the world of finance. Over the years, he has become a prominent political and social figure, using his wealth and influence to advocate for liberal causes and global democracy. As the founder of the Open Society Foundations, Soros has worked to promote human rights, economic reform, and political transparency around the world. Soros's philosophy of open society is deeply tied to his investment strategy. In both his financial and political endeavors, Soros believes in the importance of critical thinking and market transparency. Just as he seeks to expose market inefficiencies and capitalize on them, he also advocates for exposing political corruption and promoting government accountability. In the context of his financial strategy, Soros sees global markets as interconnected systems that are influenced by both economic and political forces. His understanding of the global macroeconomic landscape is shaped not only by financial data but also by his analysis of political and social dynamics. This broader perspective allows Soros to anticipate market movements and make informed decisions based on both economic fundamentals and geopolitical factors. This final section will explore how Soros's philosophy of open society has influenced his global macro strategy, his views on market transparency, and how his political activism has been interwoven with his financial decisions. By understanding Soros's broader worldview, we can gain deeper insight into how his financial and political endeavors are connected and how they shape his investment decisions. This comprehensive documentary-style breakdown of George Soros's global macro strategies provides a deep dive into his investment philosophy, global macro strategy, and how he has navigated complex financial markets while managing risk. Soros's unique approach, built on reflexivity, global trends, and political understanding, has made him one of the most successful investors in history. Through this series, we can gain valuable insights into his strategies and learn how to apply them in today's ever-evolving markets. Thank you for watching and exploring George Soros's global macro strategies with us. If you found this documentary insightful, don't forget to subscribe to our channel for more in-depth financial strategies, investment philosophies, and the stories of legendary investors. Stay tuned for more content that will help you navigate the complex world of investing in finance. Hit the bell icon so you never miss an update. See you in the next video. Goodbye.